Hi, I will start with question 1. So, question 1A, you recently received 100,000 cash after winning a competition. You decided to invest the money in the capital market by creating a portfolio. We have shortlisted 4 companies. You want to choose only 2 companies to be included in the portfolio. So, in order to choose which companies to be included in the portfolio, you have decided to perform ratio analysis and to evaluate the risk and return of the companies. And then they also give us the table of the ratio analysis that have been calculated, and also the table for expected return and standard deviation. So this question comprises of 2 topic that we have learned, which is ratio analysis and risk and return. So the first requirement is, based on the given ratios, choose 2 companies that you think should be included in the portfolio. Justify your choice according to their liquidity, activity, debt, profitability and market. So for liquidity, Gamma Berhad and Alpha Berhad recorded the highest liquidity. This is evidenced by both companies' high current and acid test ratio compared to Beta Berhad and Delta Berhad. For activity, based on the result of activity ratios, Gamma Berhad's inventory turnover and total asset turnover are the highest. A high turnover implies that Gamma Berhad's sales is strong and efficient in converting its asset to cash and generating revenue. Alpha Berhad are also not far behind Gamma Berhad in terms of its turnovers. For that, Gamma Berhad's capital structure debt composition is the lowest among the companies, followed by Alpha Berhad. This result to some extent implies a low level of the company's financial leverage, which provides low risk of investment. For profitability, Gamma Berhad and Alpha Berhad again are leading in companies' profitability compared to the other 2 companies. This is shown by the high percentage of net profit margin, return on equity and return on assets by both companies. In terms of market ratios, Gamma Berhad and Alpha Berhad recorded the highest market ratios. Their high price earnings ratios will give investors better sense of the firm's value and their performance in paying back investors. So based on these interpretations, the 2 companies to be included in the portfolio must be Alpha Berhad and Gamma Berhad. For the second question, identify and explain 2 types of information that should be obtained to be able to make better interpretation of the ratios. So the types of information needed to make better interpretation includes historical data of a company. So from historical data of the company's financial ratio, it can provide deeper insights on the performance trends and stability over time. And it also may help in identifying patterns, changes and the impact of management decisions. Next, company may also need the data of industry benchmarks. Financial ratios will be more useful when being compared to the industry benchmarks. Using the benchmark will help in evaluating companies' performance when comparing companies' financial ratios to industry averages, since the industries have different norms and standards. For the next one, assume that you are going to consider 2 options only, either to invest equally in Alpha and Beta, or to invest 60% in Gamma and 40% in Delta. Correlation coefficients between Alpha and Beta and between Gamma and Delta are 0.8 and negative 0.2 respectively. If you are a risk-averse investor, which portfolio are you going to invest in? So in order to answer this question, we must first compute and find the expected return and risk portfolio of the both portfolio. So to calculate the expected return, we first must find the proportion of each company, which is for Alpha and Beta. It is the same proportion which is 0.5, and then we will get expected return for AB or Alpha Beta 16.5%, and the expected return of Gamma and Delta, which have 60% for Gamma and 40% in Delta, we will get 21.2% of expected return. And for the risk portfolio, we must use the formula of standard deviation, and then we will get for risk portfolio AB or Alpha Beta, we will get 2.2%, and for Gamma and Delta, we will get 2.25%. As a risk-averse investor, I will take the higher risk and expect a higher return. So Gamma and Delta portfolio would be the choice, since it has a higher standard deviation and higher expected return. Next question, given the risk-free return is currently 5% and the market return is currently 18%, use the capital asset pricing model to determine what should the beta coefficient for each portfolio be in order to achieve what the expected return as calculated in 3. So basically, to answer this question, we must use the formula of required return from the capital asset pricing model. And then, so when we calculate, we will find the beta for alpha and beta is 0.88, while the required return, while the beta for gamma and delta will be 1.25. So we proceed to the last question for A, which is both standard deviation and beta are measurements for risk. Explain the difference between the two. So both beta and standard deviation are derived from historical data, but they use different formulas. Beta is useful for comparing the risk of different assets or portfolios within the same market or benchmark. It also helps investors to adjust their expected return by using capital asset pricing model, which states expected return of an asset is equal to the risk-free rate plus beta times market risk premium. For standard deviation, it is useful measure for the absolute risk of an asset, regardless of the benchmark. It helps investors to evaluate performance of asset or portfolio by comparing actual return with expected return and standard deviation. A higher return with lower standard deviation means the asset or portfolio has performed well relative to its risk level. And the last one, for question 1B, explain how funds can be transferred from suppliers of funds to those who are demanding funds within the money market and the capital market. So the money market deals with short-term debt instruments, usually with the time period within 1 year or less. Companies can issue commercial paper to raise short-term funds. Suppliers of funds may purchase the commercial paper to deploy their surplus cash. Governments might also issue treasury bills, and suppliers of funds can buy these short-term securities to provide funds to the government. Meanwhile, the capital market deals with long-term securities such as stocks and bonds, which have the time period that exceeds 1 year. Companies will issue shares of stock, and the suppliers of funds will buy these shares that will provide capital to the company. Companies and governments can also issue bonds to raise long-term debt capital. Suppliers of funds purchase these bonds as a way to lend money to the issuers.
Question 2, Part A. The question is about Kale Corporation planning to launch new healthy skincare product. They want to make the product better and stay competitive. They expect to save money each year from 2022 to 2032. They have a different discount rate for this year. So A, determine the value of the future cash flow expected to be generated by this project. The formula is finding which FV divided by 1 plus a rate and multiplied by number of years. For the year of 2022 until 2027, the rate is at 8%. From the answer given, calculate the PV using the formula stated, then accumulate the total NPV from the year 2022 until 2027. For the year 2028 to 2032, the rate is 12%. From the formula, change the rate to 12%, then accumulate the total PV from 2028 to 2032. The total NPV is 1,328,875.93. From the sum from the total PV of 2022 to 2027 with total PV from 2028 to 2032. Question 2B asking if the base criteria made set by management, should the firm undertake this project? The answer is yes. Based solely on the criterion set by management, the firm should undertake this specific project. The amount is higher than the project tolerable fallout, RM 1,100,000. On to question C. Kale Corporation accepted a project and secured a 1 million business loan repayable in 5 equal end-of-year payment at a 13% interest rate. The financial analysts need to calculate the annual interest deduction as the loan interest portion is tax deductible. Determine the firm annual loan payment. So the answer is using financial calculator to calculate the PMT. Given the PV is 1 million, the total of 5 years and interest of 13%, the PMT is 284,314.54 annually. Question D, from the calculation in part C, determine how much interest expense a KIL corporation will have in each of the next 5 years as a result of this loan by demonstrating loan amortization schedule. So for the first year, in the beginning, the total loan of 1 million will have a loan payment of RM 284,314.54 annually for 5 years. The interest portion derived from beginning of the year balance multiplied with interest of 13%. That is where we get the figures. And the principal portion comes from loan payment minus by interest portion. And lastly, the end year balance derived from the subtraction of beginning of year balance with principal portion until it gets zero balance. The confirmation of the loan amortization schedule can be done by using financial calculator. From the amount of PMT that we get is RM 284,314.54. Press shift amortization button until we get zero balance.
I will continue with the question 2 part B. After a few years of working experience as an accountant in a big accounting firm, Johnny has planned to shift his profession and commence his own business. He wishes to open a coffee and bakery house named John Hill's Bakers. To assist him in business ventures, Johnny has consulted his close friend who has been in the business for more than 10 years. To expand the business, he offers Johnny to become the investor in the business with 65,000 to be received in one of the following choices, and the discount rate is 9%. So this question is related to the topic of time value of money, which in the table that they provided, choice A is referring to the annuity due, which is to he received the amount of 6,500 at the beginning of every year, and while choice B and choice C, it implies as the mixed stream cash flow, because every year he will get different amounts. The first requirement is you are required to help Johnny to choose the right option and justify your choice to him. So here we made a table to simplify the flow from the flow of the money that Johnny will receive every year from the information given. So in order to help Johnny, we must compute the net present value of all the choices, and we have to choose the highest one. So for choice A, we compute using the formula of annuity due. Using the financial calculator, we press the beginning button, and then PMT 6,500, the years or end 10, interest is 9%, and then we will get the net present value for choice A is 45,469 ringgit 10 cents. Then for to find the net present value for choice B and choice C, we must use the mixed stream cash flow formula, and then at the end you will get the net present value for B is 42,284 ringgit 49 cents, while for for NPV for C you will get 40,885 ringgit 19 cents. So based on the computation above, Johnny must choose option A since it has the highest net present value, because it indicates that the investment would be the most profitable among the three options. The next question is, based on the concept of time value of money, explain to Johnny why time value of money concept matters to the investor. Investors will opt for investment that is based on the expectation of future returns. The time value of money concept will help them to evaluate the future value of their investments by accounting for the compounding effect over time. It also allows them to estimate how much their investments will be worth in the future. Other than that, they frequently face choices between different investment opportunities. This concept will ease them to compare cash flows occurring at different points in time on an equal basis. Investors can assess the relative value of various investments by considering their present values as shown by the above question.
Moving on to the next question, question 3, part A. This question, Mufasha is required to calculate the equity value of the company and also to consider the average growth rate of the stock. We are given the table above, the dividend per share from 2017 to 2021. So the question asks us to calculate the growth rate for each year and the average growth rate of the stock. The calculation for the growth rate for each year will be the dividend paid in the current year minus with the dividend paid in the previous year divided by the dividend paid in the previous year times with 100%. For 2018, the answer will be 6.10%. For 2019, the answer will be 10.34%. For 2020, the answer will be 3.13%. And lastly, for 2021, the answer will be 3.03%. The calculation for the average growth rate, the PV is the first year dividend paid, which is 2017. For this question, we need to find the I. So the PV must be negative. So the PV will be negative 4.10. For FV is the last year of the dividend, which is 5.10. And the N will be 4 because the calculation must be made based on the number of years, such as from the 2017 to 2018 is 1 year, from 2018 to 2019 is the second year, for 2019 to 2020 is the third year, and lastly for the fourth year from the 2020 to 2021. So the I will be 5.6079%. For question B, in 2022, the company paid RM 5.92 dividend. Nufasha believed that for the first 2 years, the company's dividend will grow at the average growth rate calculated in A above. Later, the growth rate increased to 8% and will again grow constantly at that rate. If the required return is 10%, what is the value of the stock? So we have acknowledged the constant growth rate and the variable growth rate. So the variable growth rate requires 2 years, which is T1 and T2. The dividend paid is RM 5.92 cent. So the DO equal to 2022 dividend, which is 5.92, and the fair value interest factor based on the T1 is 1.0561 and for T2 is 1.1153. In order to get the DT, we need to multiple 1 times 2, and we will get for the T1 is 6.2521 and for T2 6.6026. Then we will get the present value interest factor for T1 is 0.9091 and for T2 is 0.8264. The present value that we will get, we will sum out in the total. So the total present value of the dividend for the variable growth rate is 11.1402. So for the constant growth rate, we need to calculate using the formula. So the formula is based on the 7.1308 divided by the 0.1, which is the required return, minus with the 0.08, which is the increased growth rate. We will get the, for 2025, the value will be 356.54. So the value needs to multiply with the latest present value interest factor, which is 0.8264, and we will get the dividend for 2025 is 294 ringgit 6447, and the present value for the 2035, we need to add the present value of the dividend in T1 and T2 plus with the 294.6447. The total will be RM 305 ringgit 0.7849. For the next question, question 3 part B, Kate Somerville is planning to invest in bonds and find an experienced broker to assist her on the calculation of bond. So the broker has presented two different bonds, which is Cagamas and Cerah Capital. The bond issued by the Cagamas has maturity of 6 years, par value of 1,000 and a yield to maturity of 6.5% and also a coupon rate of 5.25% paid annually. However, for the Cerah Capital, it offers 1,000 par value bond at the same yield to maturity and the maturity period, but at the coupon rate of 7.7% paid annually. So the question asks us to compute the selling price for Cagamas bond and Cerah Capital respectively. So for Cagamas bond, the maturity will be 6 years, so N equal to 6. The par value is 1,000, so fair value is equal to 1,000. The coupon rate is 5.25% paid annually, so the PMT will be 5.25% times with par value of 1,000. We will get the PMT is 52.5 and the I will be 6.5% because the yield to maturity is 6.5%. So the PV price for the Cagamas bond will be RM 939.49 sen. For Cerah Capital, the N will be 6 because the maturity of 6 years, and also the par value also same with Cagamas, which is 1000. And for the coupon rate, the paid coupon rate for Cerah bond is 7.7%, which is the PMT will be 7.7% times with par value 1000. We will get the PMT is equal to 77, and the I also equals with the Cagamas bond, which is 6.5%. So the PV for the Cerah bond will be RM 1058 ringgit point 9 sen. Based on the next question, question B, Kate would like to invest 50,000 ringgit either in Cagamas or Cerah Capital. We need to calculate how many of those bonds she can buy if she wants to invest only in Cagamas, and how many of those bonds she can buy if she only invests in Cerah Capital. We need to run our answers to the nearest integer. The calculation for this question is the initial investment must be divided by the PV of each bond. So for Cagamas Capital, 50,000 must be divided with RM 939.40 cent. We will get 53.23. So when we run out, we will get 53 bond. For Cerah Capital, 50,000 ringgit must be divided by 1,058 ringgit point 09, and we will get 47.25. When we run out, we will get 47 point. Moving on to the next question, question C. What is the total annual interest income that Kate could earn each year if she invested only in Cagamas, and the total annual interest income if she invests only in Cerah Capital? So for Cagamas Berhad, the par value 1000 need to times with the coupon rate of 5.25%, we will get the PMT is 52.50 cent. So 52.50 cent need to times with the quantity of bond when she invests in Cagamas, which is the 53 bonds. So the annual interest income that Cat could earn is RM 2,782 ringgit point 50 cent. Meanwhile, for Cerah Capital, 1000 par value needs to time with the 7.7% of the coupon rate, and we will get the interest for the capital is 77 ringgit. For the 77 ringgit, we need to times with the number of quantity for the bond for Cerah Capital, which is 47 bond. So the annual interest income that we will get is RM 3,619 ringgit. Moving on to the last sub question, question D. Suggest to Kate on better investment and why we choose the case. So the answer that I wrote is she should invest on Cerah Capital since the investment has higher annual interest income at RM 3,619 per year. This amount was calculated based on the previous question. So furthermore, the Cerah Capital's bond also have higher selling price, showed the bond was traded at premium, so it could potentially give higher current income.
Okay, now we move on to question 3 part C. The question 3 part C is about estimate the weighted average cost of capital of the new investment if internal sources of common stock and preferred stock are used and debt are used. Okay, for this question, I use formula and not use a financial calculator. Okay, for I use a step by step to it's more easier to understand. Okay, for the step one, to find cost of equity using CAPM. So to find cost of equity or cost of common stock, I use a CAPM formula. So I got 10.6%. Okay, next we go to step two. Step two is find cost of preferred stock. Okay. To find the cost of preferred stock, I use the formula annual dividend divide to net profit. So I got 4.375%. Okay, next we go to the step 3. Step 3 is find cost of debt. Okay, to define cost of debt, I use formula interest rate multiply with 1 minus corporate tax rate. So I got 4.2%. And lastly, step 4, we find the WACC. WACC is weighted average cost. Now, weighted average cost capital. Okay, to find WACC, weighted debt multiply with cost of debt plus with weighted preferred stock multiply with cost preferred stock and plus with weighted common stock plus with cost of equity that we use in CAPM. So the final answer WACC is 8.075%.
Question 4. The question is about nanobot Sunan Mahat is deciding whether to repair its current delivery truck or buy a new one. The old truck, if repaired, will incur increasing annual maintenance costs and has a potential scrap value after 5 years. If not repaired, it can be sold immediately. Alternatively, a new truck can be purchased for RM 220,000 with reduced maintenance costs and increased efficiency. Nanobot expect a minimum 10% annual return on new investment, considering a 24% corporate income tax rate and specific capital allowance for the new truck. A. Using the cash flow estimation for the investment analysis format, these are the answer. So cost of new truck is 220,000, MV of old truck is 3,000. Tax effect is 2,160. There is no increase in NWC. The total initial investment is 214,840. After tax increase will be explained in the next slide. Depreciation for new and old equipment is the cost multiplied with 40% in first year and for the second to fourth year times with 20%. So tax saving from depreciation is the change of this depreciation multiplied with tax rate, which is 24%. Total up, we'll get the net operating cash flow. MV for new equipment is given 42,000 and tax rate is derived from 3,000 multiplied by 24%. These are the working one. 3,000 minus 15,000 will get loss of 9,000 and times with 24% of tax rate. So for after tax increase in working 2, the calculation is increase in profit plus repair maintenance all minus by new multiplied by 24% of tax rate.
Okay, so question 4, the next sub-question is evaluate the proposal using payback period. Using payback period, should robots repair the existing truck or purchase a new one? Explain your answer. Okay, the answer we get from payback period is 6.5 years. Okay, the payback period is more than 5 years, which is 6.5, which means the company should repair the truck. Okay, the next sub-question is evaluate the proposal using NPV. Using NPV, should Nandaberg repair the existing truck or purchase a new one? Explain your answer. The NPV is below than 0, which is negative 97,172, which means the company should repair the truck. Okay, so we're still in question 4. The for question 4 is D. Evaluate the proposal using internal rate of return (IRR). Using IRR, should Nanoboots repair the existing truck or purchase a new one? Explain your answer. Okay, my answer is because the IRR less than the cost capital, which is 10%. Thus, the company should repair instead of purchasing a new truck. Okay, the last question for question 4. Explain why the process of capital budgeting emphasizes more when evaluating the cash flow pattern of the proposal rather than accounting profits. Okay, my answer is capital budgeting is concerned with evaluating the cash flow pattern rather than accounting profit because cash flow represents the actual inflows and outflows of funds over time. Accounting profits may include non-cash items and do not always reflect the timing of cash transactions. Evaluating cash flow gives a more accurate picture of how the project will affect the company's liquidity and financial health.